Jobs in the United Kingdom got hammered in November and then again in December. And as lackluster and as dim as the Christmas shopping season turned out to have been in the United States, it was far worse in the UK. Now, many are blaming the British government and its introduction of a payroll tax, but that won't be effective until April. What we're seeing in the labor market in the United Kingdom is the same thing that we're seeing all over the world. In addition to the United States, Switzerland, for example, the place which kicked off the current global rate cutting cycle, that got started on worries about exactly what's unfolding now. The Swiss National Bank had been warning that global weakness could harm the Swiss economy, and here it comes. Not only is Switzerland facing the possibility of negative consumer prices, that possibility is being accompanied by the highest unemployment rate since the middle of 2021. Sweden's unemployment rate outside of 2020 is the highest that country has seen since the third quarter of 2010. There was a sharp spike in South Korean joblessness in December, no surprise given the political disintegration. Yet that turmoil also stems from growing problems in the South Korean economy as the global AI bubble cools off. Canada, Japan, even places like New Zealand. Economists and central bankers, same thing, have said that this is all just normalization after a period of red-hot economic growth. But as I've repeatedly shown, there has been nothing normal about the economics of the past few years. That so-called red-hot growth was a nominal price illusion, one that is being exposed for what it is because labor market conditions all over the world, even in places you wouldn't expect, unemployment continues to rise well past any point of normalization. The British labor market is perhaps the best example of everything that we've been talking about, what I talked about in the video over the weekend. Not normalization, an economy that doesn't look like recession, but one that certainly seems to have forgotten how to grow. And if the economy can't grow, it can't generate jobs. And at some point, many businesses are going to look around and say, we've got too many workers. Well, the British economy seems to have gone past that point, as has so many others around the world, more than you would think. And in some places, as I said, you might not expect. Starting with the British, what the British government reported just this month is that payrolls in the month of December fell by nearly 50,000, which is a lot for the British economy. And that came after falling by 32,000 in November. But it wasn't just November and December. As I said, the British government announced a payroll tax hike in late October that will become effective in April. So it wasn't the announcement of the tax hike that did it, because British payrolls had been negative even before then. There was a positive in October, but over the last 5 months, August through December, British payrolls have dropped by nearly 80,000 combined. The unemployment rate in the UK, which had risen to 4.4% earlier in 2024, after a short summer reprieve where it backed down to 4.1%, it's right back to 4.4% all over again and looking to go a lot higher. On top of the growing labor market troubles in the UK, now we see consumer spending that backed off a tremendous amount in the holiday shopping season, the crucial holiday shopping season. According to Bloomberg, UK retail sales posted a surprise fall around last month's crucial Christmas period in a fresh setback for the Labour government's hopes of reviving economic growth. The volume of goods sold in stores and online dropped 0.3% in December. This is volume, falling a 0.1% gain in November that was revised down from 0.2%. Economists were expecting a 0.4% increase for last month. So it's a major miss in a major part of the calendar. From an expected 0.4% increase in volume to minus 0.3%. So a huge shift in consumer spending in December in the UK, which raises a number of questions. What is actually going on there? It's the same story that we see everywhere, continuing. Cautious spending defined the festive season, slowing momentum in retail, said Nicholas Found, who's the head of commercial content at Retail Economics. Scars from the cost of living crisis saw fragile consumer confidence persist in December as shoppers adapt to higher prices, prioritizing value during the Christmas season. And it's the same thing that we see everywhere, lost purchasing power, but it's also combined with this deterioration in the labor market. That's where fragile confidence is coming from. Consumers know that they lost purchasing power during the pandemic, the supply shock, the price illusion, it wasn't inflation. And with the labor market increasingly weak, they know they're not going to get it back. Plus, now they have to worry about, are they going to lose their job? Are they going to lose their hours? Are they going to have the same incomes? There's lack of opportunity to go to someplace new. A whole host of problems that is combining into the mess that we saw in December. But that's not what the media says. Instead, the media adds, these figures add to anecdotal evidence of a disappointing Christmas season for retailers, more than disappointing. So despite growing real incomes, households are in a cautious mood amid warnings of an inflation resurgence and expectations of slower declines in borrowing costs. That's what you hear in the mainstream media because it comes from central bankers and economists. When survey after survey shows that consumers are not afraid of resurgence in consumer prices, whether they call it inflation or not, that's not what they're focused on. They're focused on labor market, jobs, and incomes. But they also have to throw in there the fact that the Bank of England is taking a more cautious approach to lowering interest rates, as if lower interest rates or the speed at which the central bank undertakes them is going to make a big difference in the spending patterns of consumers. There's a big conceit there. And by the way, one that I covered in the Eurodollar University's deep dive analysis, including the March 1991 FOMC meeting and what happened during it. The Fed had been hiding for years the truth. They lied repeatedly. In fact, in that March 1991 meeting, the Federal Reserve itself admitted, officials of the Fed and the FOMC admitted that they were lying to the public about what it is the Fed actually was and what it was up to, what it's been doing. For 17 years, as I went over in that DDA, the Fed had hidden transcripts of these meetings or recordings of these meetings because they didn't want the public to know the Fed was being transformed into something it didn't think it wanted to be. So ever since then, the Federal Reserve, like every other central bank, has been targeting interest rates and selling the public that interest rates are the most important variable in everything, everywhere. So like I said, that's at our Eurodollar University deep dive analysis, and there's a lot to this story, uncovering the truth behind the Federal Reserve and what really happened in its transformation from the 70s, 80s, into the 90s, to get to where we are today, where everyone believes the Fed controls interest rates and that interest rates are the only thing that matters. And this passage from this news article, another piece of evidence showing that, for the mainstream anyway, it's always about interest rates, it's always about central banks, when back in 1991, the Fed said we're lying to the public about all of this. But that's Eurodollar University's deep dive analysis. Check out the subscriptions at our website, eurodollar.university. But it's not just the UK. Like I said, this is a phenomenon that's all around the world. We can see it all around the world. Another really good example I've talked about many times, Germany. Germany, because it's maybe one of the most weak economies that there is in the Western world. Of all the developed economies, certainly that's the case. The unemployment rate there has risen to 6.1%, where it's been each of the last 3 months, as unemployment slowly rises month after month in Germany. That 6.1% is actually very near the official 2020 highs, and outside of 2020, it's the worst since July of 2016. So Germany, you know that one. That's where we see labor market deterioration. One of the best examples of that, along with the UK. But even in France, Europe's second largest economy, we've got a sharp rise in joblessness September, October, and November. November's the latest data that we have. And like Britain, the unemployment rate in France had dipped in the middle part of that year, although closer to the second quarter in the spring. But ever since the second quarter, jobless claims have risen and the unemployment rate is rising, and it's likely to rise a lot more in the fourth quarter of 2024 as well, heading into 2025 on the wrong foot. The same as we see in Germany and the UK. But Switzerland may be a surprise to many people because it's thought of as a safe and steady economy. But the truth is the Swiss economy is heavily dependent on global forces and global factors. In fact, the Swiss National Bank, ever since March of last year, when it kicked off the rate cutting cycle among central banks, it repeatedly cited global factors for its decisions. Now that the latest update for December, when they cut by 50 basis points, shocking everyone, they came out with a forecast that showed their prediction for consumer price rates in late 2024 and into 2025 were uncomfortably close to zero. And the only reason they didn't cut it, they didn't show it at zero or maybe even negative prices was because of that 50 basis point rate cut in December, because central bank models, like all econometrics, immediately assume that rate cuts are going to be effective, and therefore that will help keep consumer prices on the plus side of zero. When in reality, the economy is increasingly weak, which is the reason why consumer prices are threatening to go negative in the first place. And we see that in unemployment. Unemployment in Switzerland began to rise in the middle of 2023, like a whole lot of places, including the United States. It went from a low of 1.9% to 2.5% by January of 2024. Then we got a seasonal dip in Switzerland first part of last year, before it then jumped to 2.8% by the end of last year. So that was more than half a percentage point above December 2023. And so the argument about normalization doesn't really fly here, because the unemployment rate, as low as it is, it's still relatively low, but it is higher than both December of 2018 and December of 2019, and it's really not that far off of December of 2017. So the labor market in Switzerland, because of global economic factors and the global economic downturn, has gone beyond what would be reasonably called normalization, and has now risen to increasingly uncomfortable, even from the Swiss National Bank's perspective, dangerous levels. That's why the Swiss National Bank aggressively cut rates to end last year, because it's starting to see more clearly the downside in the Swiss economy as it's being driven by these global negative factors. The Dutch, Netherlands, the unemployment rate there is moderately rising. It's kind of consistent around the 3.7% level, at least for now, and it really does look like normalization. So you could use the Netherlands as a case for normalization. But the Dutch labor market is one of the few and one of the only ones that it looks like things are relatively stable there. On the other side of that, there's the Italian labor market. That's one of the few examples, the really few examples, where the unemployment rate continues to drop. And in Italy, the unemployment rate has already hit record lows and keeps going into further record lows every month the data comes out. But what we're seeing in Italy and the Netherlands, those are the exceptions. Far more often, we find what we see in the UK or Germany or France or Sweden. Swedish unemployment rate exploded to 8.4% in the third quarter of 2024. That's up from 7% at the low in the second quarter of 2022, which coincides with this global recession, or the global economy that just forgot how to grow. It may not look like a global recession, as I said in that previous video, but it is every bit of one, including how it's creating these problems, the losses in employment throughout the jobs markets around the world. 8.4% for Sweden. That's miles above the 2018 lows of 6.4%. You're talking about 2 full percentage points. So that's not normalization. And as I said in the introduction here, 8.4% is the highest since the third quarter of 2010. Now that's outside of the 2020 pandemic, but 8.4% highest since 2010. So there's another example of an economy that's experiencing a lot worse than just strictly normalization. In fact, the Swedish central bank, the Riksbank, one of the oldest in the world, has admitted that the Swedish economy is in substantial trouble. Canada's another one where the unemployment rate has risen uncomfortably high. We already know about the Bank of Canada. And the reason we focus a lot on Canada is because there's a high degree of correlation between what's happening in the Canadian economy and the United States economy. As uncomfortable as that may make people, as unemployment rises more noticeably in Canada, we should expect a similar trend to develop and continue to develop in the U.S. labor market. But the Canadians had 2 solid payroll reports, sort of like the U.S., in November and December, which allowed the unemployment rate to dip from 6.8%, which was the highest since 2016, down to 6.7%. But like the United States, the Canadians still have a participation problem. In fact, a major participation problem, which means the real unemployment rate is far higher than even the 6.7 or 6.8% that were reported over the last couple months. New Zealand. New Zealand's economy that's really struggling for a couple big reasons, really big damage during the pandemic period, severe lockdowns, but also because New Zealand is highly dependent upon what's happening in China. They're very China adjacent. And the unemployment rate was down around 3.2% at its low in the third quarter of 2022. There's another one. We keep coming back to the same timing. And by the third quarter of 2023, the unemployment rate in New Zealand was up to 3.9%. And as of the latest data, the third quarter of 2024, it shot up to 4.8%. And once again, that 4.8% is well above the 2018-2019 level. So once again, we see it's not normalization after a red hot economy in 21 and 22. Instead, the economy stopped growing in 22 and 23. And while it doesn't look like a recession, or at least what most people imagine of a recession, we're getting all of the consequences anyway, because even if you're just going along sideways in terms of GDP or anything else, sideways for a prolonged period of time is every bit of a recession and a contraction. And the longer a period of time that you're stuck going sideways, the worse it actually gets, especially in terms of the labor market, because companies realize they don't see any upside. They look at their payrolls and think, we've got way too many given that we were expecting things to pick up, and it doesn't appear like they're going to. So rising unemployment is all of these businesses around the world throwing in the towel on the idea of an economy that was either red hot or sustainably hitting some long run potential that's just going to continue on into the future. No matter what form the unemployment rate and what path it's following in whatever place around the world, it's the same thing in most of these places. It's not normalization, it's the downside to the supply shock. And what that means as far as the labor market and the economy, well, here's what I said over the weekend in that previous video. So what really happened? Well, these were pandemic distortions. We had basically governments come in and undertake the least productive means of redistribution that you could possibly imagine. Governments literally paying people for absolutely nothing. Governments giving out what they called loans, certainly in the US, the PPP, which ended up being grants or gifts, again, for doing literally nothing. You had a price shock that benefited the least productive parts of the global economy at the expense of the most productive parts, demand destruction. And don't forget how much damage the lockdowns themselves did, especially to smaller businesses that disappeared and never came back. It created an artificial high, and central bankers and politicians since then are in denial that it didn't lead to the sustained long-run recovery that they were all promised and that they promised the public. That's where you get the political angle in all of this. They're in denial, saying and realizing and admitting it didn't actually work. And that's what this process is. It's a transition from that distortion to a more stable equilibrium, when that more stable equilibrium, as we see in German GDP or the US labor market data, is much less than it was supposed to be. It's much less than we need it to be. It is not a recovery. It's a stopped recovery. And this straight line sideways, this unusual pattern, whether it's a recession or not, it doesn't matter because it's happening and there is no sign it is going to stop. So companies all over the world, back during the early emergence from the pandemic and lockdowns, they hired for the economy they thought they were getting. They started to ramp up hiring because it was difficult to get employees. Plus, everyone was telling them these good times, or what looked to be good times under the price illusion, they're going to last forever. You're going to need employees. And then over the next couple years, all of these businesses, they kept getting disappointed by the economy. Some benefited, some were successful. But by and large, most of them were waiting and waiting and waiting for this red-hot economy to show itself and be sustained moving forward. Instead, disappointment after disappointment after disappointment has led businesses all over the place to start throwing in the towel on hires that they didn't really need to make and that they've been holding on to and hoarding for the last couple of years, waiting and waiting for the full recovery to finally show up, only to realize over the last couple of years that it's not going to show up, that it was not a red-hot sustainable recovery. It was all, or mostly, an artificial illusion, distortions, harmful distortions that we're now having to pay for. And by we mean regular consumers who lost a tremendous amount of purchasing power. And now the real downside to all of this, having lost that purchasing power, now they're also losing their jobs. The world didn't forget how to grow. It's a recession that just doesn't look like one any of us has ever seen before. Went over the details, that video I've been talking about, that's the one link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.